We operate in tier 2, tier 3, tier 4 cities where we have niche products in which we believe in: MSME, microfinance, microlab, gold, both secured, unsecured, which are our strengths.
Banking is actually, to be very clear, is after all we entered, or probably before, so some of them, some of us after, is a real long-haul business. It's not a 5-year business, 10-year, it's actually 10 to 25 years and much more than that.
So this is the last session of the day, and we are going to discuss about small finance banks and are they ready to transition into universal banks. So just to set the context, the Reserve Bank of India conceptualized the idea of small finance banks back in 2014. Then to create, the objective was to create a class of banks that could serve smaller customers through low-cost operations and tailored financial products. Subsequently, in 2015, it granted a set of licenses to small finance banks, and since then, almost 12 small finance banks have been operating in the country. The Reserve Bank of India has also laid down norms for small finance banks to transition into universal banks, and earlier this year we saw AU Small Finance Bank getting the nod of RBI to transition into a universal bank. In this context, we are today going to discuss, are SFBs ready to transition into small finance banks? So I'll dive straight into it, sir. My question to both of you is, earlier this year, as I said, we saw AU SFB getting RBI's nod, but recently we saw Jana Small Finance Bank's application was returned by RBI. Now, does that create a confusion in the minds of other small finance banks as to how to transition into a universal bank, or are the norms clear for other banks?
Hi, good evening. Difficult session, huh? Last one.
Yes.
Bhaskar and I, peer group for Small Finance Bank will try and represent the whole set, which is 11 of us. At the outset, Subrata, Reserve Bank has been pretty clear on the glide path to become a universal bank. There is set criteria. It has been restated in the recent circular. To just enumerate, the SFB should be listed. It should have 5 years of good performance. It should have 1,000 crores of net worth. It should have NNPA and GNPA at 1% and 3%. And it should have CRAR at 15% plus. It's fairly well defined. So there's no ambiguity on that. Anything better than that would, of course, be the right way to do it. But at the outset, I want to state, and I'll ask Bhaskar to back up on this, small finance banks are in a very beautiful place. They're in a good place. Small is beautiful. The reason is we operate in tier 2, tier 3, tier 4 cities where we have niche products in which we believe in: MSME, microfinance, microlab, gold, both secured, unsecured, which are our strengths. We reach and we get customer acquisition ourselves. We make small loans, and that permits us to get slightly higher margins than what the large banks traditionally get from large corporates. That's important for us, because for us, being relatively small and new, our cost of deposits also is slightly higher. So the NIMs, the difference between lending and borrowing, has to be healthy. So I think we are entrenched very comfortably, working steadily year after year, getting to the position to become large. We are like, not toddlers, we are young teenagers, and we are, tweens in between, trying to become confident, relevant adults in the banking industry in a steady way by which we contribute well towards India becoming the 3rd largest economy in the world.
Shubhad, I think broadly, if you look at the small finance banks are not necessarily small. Together, if you take multiple matrices in terms of reach, it's pretty significantly large. For instance, the deposits have grown at 38% CAGR, while at an overall banking level, if you look at it, SFBs hold only 1% of their overall deposits, and approximately 1.5% of the assets. But by the number of employees is approximately 8%. By the number of the branch network, it is 5%. By the percentage of the reach, probably even the smallest of the small finance bank serves approximately 0.5% of the Indian households. Put together, approximately it's another 8 to 9%. So the very purpose for which the differentiated banks came for small finance bank is to really make the banks reach the customers. Everybody had an account. Everybody, what was the need for a space? Is that being felt welcome in the bank and being serviced was objective. To that extent, I think the experiment has been fairly successful. The natural progression of the small finance banks, one of the key challenges is that name tag, which you all carry as small finance, many a times is a little bit of a hindrance for us to, you'll ask me whether I'm regulated, whether I'm a scheduled bank, which category, what does small finance bank means. So we have been making our representation to the regulator, and many a times some of the regulatory dispensations or approvals come after multiple rounds of representations, because there was a purpose for which we came, and we're saying, yes, we did the purpose, we're not going to be deviate, but this would really enable us to become. So that probably is one of the reasons also all of us wanting to become the universal bank. I want to be known as a Suryodaya bank rather than a Suryodaya small finance, which I kind of jokingly say, including a mother-in-law's, whether you are a bank. So we'll have to kind of probably, these are the small asks. But to be very fair, the regulator, without much of a ask from ourselves, we got the PSL now coming down from 75 to 60. So there's a glide path. Probably either we will all become ready, or over a period of time, the convergence will happen in a way. Probably I will even, in a light-hearted sense, I will look at it, saying that probably the regulator will say, now with all this fulfilled, you are eligible, kind of apply and take. Probably that also can happen. There are certain people who have, 3 of them have applied to my, So it was AU which got the approval, in principle approval, so to say, to be very clear technically. And then Jana, kind of, it has not been rejected. It has been returned for them to kind of come back after fulfilling certain criteria, which the bank probably believes that they fulfilled, and the regulator in their view is still not really crossed the line. Banking is actually, to be very clear, is after all we entered, or probably before, so some of them, some of us after, is a real long-haul business. It's not a 5-year business, 10-year, it's actually 10 to 25 years and much more than that. So if you have to, it's a game of being patient. Many of the risks that we play, we ourselves do not know. So we'll all get to know about it after seeing 2, 3, but it has been a baptism by fire for SFBs. Just before we started, we had Demon. Post that, we had COVID. Post that, now we have microfinance crisis. I think some sense we connect the dot backwards in philosophical sense is actually good, because what strengthens a bank or a financial lender or specifically a bank is that going through the cycles and surviving, and if you survive, you'll win. And probably we are in the phase. So my opinion is that we are ready, but is it ready today? Will we be kind of, though we are ready, will we wait out? So each one will take a path. I would say that we would rather watch, take a year or 2, do it, because whatever a universal bank can do, actually we do, except for certain things, which anyway, even if the LOI will not really be able to do it. So that's where we are.
Does size play a role here? Because we saw AU has a loan book of around over 1 lakh crores, and Jana probably didn't have that big as the loan book. Ujjivan is around 30, 35, 40,000 crores. So does size play a role here? I mean, if you are a large enough loan book, you probably are better placed to get a nod.
Okay, I think it's not just size. It's a little more complex than that. It's more of diversification. It's also the ability to go in many geographies. See, Reserve Bank has been wanting all kinds of banks, whether they are universal, cooperative, small, to broad base their customer base. This is something which is not new. This is something which has been echoed not only for SFBs, but for the large universal banks. We have recently read in the papers that several banks are getting merged, and they already have large balance sheet sizes. It's because they will complement each other's strengths. So I think one of the big things for us, and Bhaskar and I regularly interact with the Reserve Bank, is to get a little more leeway into co-lending, by which we diversify, by sparing up our risk-weighted assets, which Reserve Bank has done to an extent. The PSL requirement has come down from 75% to 60%. So some results we have seen, and that has been persistent effort. So all of us have been doing that very systemically and systematically. And not only in the asset classes, we start by going to industry to see where the white spaces exist. Then we hire people for it, but we don't copy the model which has gone well so far. We have the advantage as small banks because we're starting up to be more digitized than the average other banks, other type of banks. So our journeys are mostly paperless. For example, in microfinance, one would think in villages there'll be a lot of paper and all. There is not even one wet signature. Not even one signature. It's completely digitized with the help of Aadhaar. So, our rural folks, because of our UPI, our smartphones, are very ready to work with digital products as long as banks make it easy on the delivery part and customer service part. So we have this really advantageous position to leapfrog and go away from the traditional methods of banking into what is going to be a more efficient, lower cost, and deeper penetration banking into Bharat, which is the forte for us.
So your view is the size really matters?
Size does matter, but what also is happening is that some of the things, as Inder rightly mentioned, exponential growth is coming not by the way in which traditionally done. It's being unreasonable size can come out of because of the technology of the infrastructure, public infrastructure, digital infrastructure which has been built. As a bank, it took 8 years for us to get 3 lakh digital deposit customer. It took around 6 months to get 1 lakh customers in FD through digital. Obviously, this all happens through a partnership. Fintechs are the best in CX. Fintechs are the best in acquiring customers digitally, which there is no point in us trying to kind of learn that, rather partner with them. And that's a scale. If you really do that, size does really certainly matter because investments becomes very important. But however, I think the overall requirement for being technologically superior today has got democratized. So if you look at the smallest bank to the largest bank, as long as they are meaningfully investing, it is not necessarily proportionate to how much of money you are spending. It's the way in which you really spend. So size does matter, but not that's the only thing that matters.
You both spoke about the PSL relaxation that RBI has provided. So what business segments does it open up for small finance bank, and which new product segments are you going to get into because so much of capital is going to be freed?
Yeah, we all understand capital is a scarce resource, and we always employ it in the areas where it makes sense for us, both on return and on risk. There are several areas for us to actually grow. In fact, we are quite blessed. The areas to grow are many. Now the question is, where can we actually get strengths and where we can get our specializations to do? There's also, we talked about diversification of asset classes. There's also another move happening in the banking sector of India, especially in our peer group, which is to go more for secured assets, away from unsecured and more for secured. Reason is actually pretty clear for that. So what we're doing is we're employing the RWA, which has got freed up by lower PSL. And I'll come to what else we are going to need. And we have started classes in which we are going into things like micro-LAP. And micro-LAP that's lending against property. And that's not only in big cities. It's mostly in tier 3 and tier 4 towns. Small size, below 25 lakhs, between 7 lakhs and 25 lakhs. We are also going in for gold loans, and that's across. That's in the urban areas, the metros, the tier 2 and tier 3. Everywhere there seems to be a need to use their idle gold to encash it into working capital. This gold getting pledged with banks is not really money getting blown up in vacations and buying expensive gifts for each other. It's one of the best sources for working capital funds for small industries. A gold loan, you can get typically 11, 12%, maybe 13. And that provides working capital at the time you want it for your cycle of consumption in a small MSME. And that is something which is really important. Because for an MSME to get a loan takes a long time in the normal course. And a gold loan can be done almost within a few hours. The third class, which we are trying to get in a good way, is basically to go in for what we call secured cards. What is a secured card? It's pretty much like a card you and I have, But many people in India don't have a credit history. So we have introduced what we call a credit builder card, by which you give a small credit line to the person, and that person conducts himself or herself well for a few months. The CIBIL score builds up, and then we can go in for a larger loan, and the person suddenly becomes existing to banks. And that, in my mind, is one of the biggest things which will happen. It will permit young students, both in small towns and in big cities, to get a small credit limit upfront without a supplementary card on their parents. And it will enable our youth to have skills developed in what I loosely term as Bharat, to do the skill set enhancement, whereby after their education, they can actually go and do internships and build skills which will take them into industry. So, Bhaskar mentioned this. We are small by name, but I want to tell you we're not small by size. We have about, between the 11 of us, we have 3.5 crore active customers. 3.5 crore active customers. If a household in India is 4 people, 3.5 into 4 is 14 crore people are touched and affected by us. That's almost 9% of India's population. So we are small in size, but we are very deep in our reach. We provide funding to get the people out of a debt burden cycle. When we go into MFI, microfinance, currently it's not the flavor of the season. But when we give that small loan, 70,000 rupees to that woman in a very small town to do her trade, her shopping, her weaving, her fishery, we uplift that family from a kind of a cycle of poverty into something steady. And when small finance banks do that, that woman and her friends have that guarantee that there are funds available for me. Someone will give me money next year also. And they will give it to my friend and my neighbor also. So we actually release them from that trap of money lending at a village level, which can be very expensive. So we give them money at a respectable rate of interest, which might seem a little high at times, but it is half of what they would have otherwise paid had they taken it from the local money lenders. So SFBs are staying true to the purpose. We have got differentiated licenses. We've got licenses to serve the underbanked, underserved people deep in the heartland of India. And I think the Reserve Bank is now going to call this experiment increasingly a success.
So your views?
Yeah, the 75 to 60 is not going to immediately open up huge opportunities. But what it does, that just that there is a leeway will enable us to think that whether we can really do things beyond what we have been already doing. The other one certainly is in terms of to the existing customers whom we are serving. We will be able to add products which not necessarily will qualify as PSL. So it just opens up the window. Since it was already 75, the ability to even plan was not there. Now that it's available, nothing is going to really magically happen this year. But the fact is that it opens up in terms of how to create a little bit of a robustness. The weakest link, and probably in the SFB structure, had been that majority of us came from a microfinance background. So what we are comfortable, we are kind of continuing to build. We are not doing anything. If it is not broken, why fix it? Probably. So that I think to the microfinance crisis has opened it up. While there are credit guarantee schemes which are available, which I think all of us are going and kind of guarding ourselves. So this kind of the risk mitigation which is happening is what we will be able to now do it from a 75% to 60%. So I think probably in the future, next year onwards, it will be of use to us.
Does this also open up a market of PSL certificates that you can sell to other banks who probably are in need of such certificates to meet the criteria? Because now your 15% is free.
So the challenge, only the demand for a PSLC is in terms of small and marginal farmers, where you make some money, and that anyway the requirement remains the same at 8% of your overall requirement. So anything in excess, anyway we are spending. So the 75 to 60 is not likely to translate into any excess PSLCs. So selling, translating into profits.
I agree with Bhaskar. See, I think the big one which we're now chasing is to make our capital adequacy come down from the high levels to moderate levels. See, the capital adequacy norms in India, our small finance banks are required to keep 15%, whereas normal banks are required to keep 9% with a 2.5% buffer, which is 11.5%. So essentially, we end up keeping almost 33% more capital adequacy. We have been requesting the regulator, if that can come down in a glide path, it doesn't have to come down in one shot, maybe in two, maybe in three shots. That will free up a lot of capital for us. And that will actually translate into an acceleration of the balance sheets. We have demonstrated that we are responsible banks. And great professionals run all 11 banks right now. And we have very, very nice boards which are governed by professionals again. So, that comfort is there with the regulator that this is a good place to be. So now, having seen us perform most of us for the past 8 years, I think it's time to consider relaxation in capital adequacy also. That will help.
Do you also agree with that there should be some relaxation on capital adequacy by the regulator?
Depends. I think if you look at overall worldwide, including look at the current universal banks, most of them are sitting on a capital adequacy which is almost double of the requirement by the regulator. So to each would be the requirement. I think depends on individual banks. Somebody who is in secured lending probably can get away. I mean, it would be good to probably have a little lesser capital adequacy. But if the model like what we are at 50-50, I would still veer towards having maintain a higher liquidity. Always it's good to regularly require a little lesser threshold and to each in terms of what you really want to maintain.
You touched upon microfinance, and we have heard from various banks as to where the stress is and how much has been resolved. But are we going to see an end of this cycle very soon, the stress cycle? Because this has been going on for a few quarters now, and it has impacted all kinds of banks, be it small finance banks, large banks, or NBFCs. So when do we see the end of this stress cycle of microfinance?
Okay, I'll try and draw a line in the sand, and that line in the sand is not a hard line. Is the point where the SROs of microfinance intervened, which was around mid of last year. There are two SROs for microfinance. One is called Sadhan, and the other one is microfinance. Both the SROs recognized that there is a problem, and this was about almost 18 months ago now. The problem was that microfinance was a fantastic business. I mean, you lend to the group of JLJ women in the rural areas. They all back up for each other. They repay your loan back with healthy margins. All is well. And then you repeat the cycle. But what happened is the traditional, killing the golden goose? All the banks decided and all the NBFCs decided, this is the place I must go and lend. So what they did, or what our industry did, is we lent to the same woman, not one loan, not two loans, not three loans, 5 loans or 7 loans, much beyond her capacity to repay. So, with all the consumption, television, social media, the person kept on taking more loans and spending it. But when the time came to repay it, money was simply not enough. It took the microfinance industry some quarters to recognize that we have actually done this too hard. Then the SROs met up, all of us sat on different round tables, and we decided that we will not lend more than 3 loans to the same woman and not more than 1.75 lakhs in total. That norm has been adhered to in the last 12 to 15 months. That's the line in the sand. So then there's an old book which has many, many loans for the poor woman to repay, and there's a new book with the newer underwriting standards which is more sensible and enables her to pay. My inherent thought is that woman, why woman I keep saying, more than 99% of the borrowers in microfinance are women. My inherent thought is that they would like to repay. No one likes not to repay, especially in that eco structure. So the new loans have been behaving fairly well in controlled NNPAs, controlled non-performing assets. Collection efficiencies are very high, but the old book, which is more than 15 months old, is showing stress. So, Subrato, the money we collect is a combination of two. As the time goes by, the old book keeps shrinking, so the problem keeps becoming smaller. And the new book, which is controlled, keeps growing, which is giving healthy results. I think that inflection point of going away from the bad times into the decent times, but not yet the good times, is about now. It's happening as we speak. I think, Bhaskar, I would, if I go on a limb, I would say 1 or 2 quarters, and we would be out of the woods.
What is your view, sir?
Yeah, the thing is that 1 or 2 quarters we're out of the woods. I hope that we don't really get in the woods again after 2 or 3 quarters. So I think, broadly put, this is a sector which can grow at 15-20% every year. But the year when we decide to grow 40%, we don't grow for many, many years. So but some of us, I don't think anybody has a real answer to what has really happened. At least I don't have. Microfinance has got 2 sets of models. One is called SHG model, which is not necessarily considered as a super efficient model in terms of scaling up. That's behaving as if everything is normal. And then we have the other model, which is usually an efficient model in good times, which is JLG model, which really makes all of us believe who are in this segment. So can I grow 40%? Can I go 30%? But I want the industry to grow at the 15%. Since each one of us really want to grow at various points, it really creates that. I think this time it has been very sharp. The learnings have been very deep. I hope the remembrance of this will last a little longer for all of us than just saying that, no, okay, it happened, now it's a good time. We're out of the woods, let's play the game. I think it's time.
I'm guessing you guys have gone slow on the microfinance portfolio in the last few quarters. But now are you, because you're saying the worst is kind of over and we are probably going into good times. So are you stepping up the gas in terms of microfinance loans?
See, within microfinance, there are several micro segments. One is the JLG, which is a joint liability group, which is a cohort of 16 women, 9 women, 25 women, normally a square number. Then there is something called the individual loan, which is derived from the good credit behavior of the existing JLG, which many banks are now calling what the Saral product, the easy product. And then there's the third one, which is the MEL, which is more inclined towards enterprise, in which their husbands also participate, or maybe their sons. So there are, and a fourth one, which is called microlab, in which you have home improvement. They put another house room, or they put a pakka roof on their thing, or they put a toilet, or they put a pump. So there are 3-4 variants which have come. What we have been observing from data which comes to us from MFIN and Saral and Sadhan is that the JLG numbers have declined sharply in the dispersals. But the overall lending to the microfinance industry has started picking up again. It's not dipped completely. There are shoots, green shoots of resurgence, and it's a mix and a change in whom to you lend and what you take as security. See, the underlying large number of people who want to get the loans is still there. We have to make sure we don't overburden them and we pick the right people to lend to, which has always been a banker's business of risk. So as long as we make the right selection, I think the market is there and it will prosper.
So your view? Are you going to increase your...
No, the segment is growing. It's not, whether it is a demon, whether it was COVID, was as bad as COVID, 80% of the customers stay intact good. So, which technically says that when there is enough so-called quote-unquote motivation for everybody to default because their neighbor is defaulting, everybody is defaulting, and nothing really needs to do. In spite of that, 80% of the customers pay in time during all of this crisis. So, which means there is a robustness of that. But the model has to change. It's not going to be that people are going to be attending meetings, they will have to be spending for 1 hour for nothing. So it is more and more it becomes digitalized. People are not wanting to, will not really come over and attend the meeting. But somewhere as a mindset, we can't really think that we have moved, we have evolved, but the customer will exactly behave the same way as they were behaving 20 years back. That time we were the only lender, and today it's an equal transaction of equals. There was a giver, there was a taker. So this model in terms of dealing with customer one-to-one is really moving up. There has to be operating costs have to come down sharply. So it no more can operate the same levels at which it was operating. So quite a bit of a tectonic shifts will have to happen and each player will have to do it. I have never slowed down and I'm not going to be aggressive. But the fact is that it's such even a bank of our size, which is around 13,000 crores at this point of time, has 18 lakh very good customers. So much more to be do. We'll have to go back to the basics, which is treat the customer and do not be only a lender. With the very fact that we all became an SFB is not to continue as a money lender. It is on the other side, if a customer is saving and the customer is also borrowing, which typically middle class do, so then the behavioral trait of a customer is very different. But if you keep them only as borrowers and do not, because the money is in lending, and you'll have to spend in terms of making them save 200 rupees, 500 rupees. There is a clarity now that only if you really work on both sides of the customer's requirement, you probably can create a business model which will be fabulous. But it's a question in terms of wanting to invest there, where there is on one side there is a spend, which is technically an invest. The other side you make money, which is lending. That I think quite a bit of an SFBs will use this opportunity to create that new model where you will have to advise the customer, trust you, you will have to get them the right policy for life insurance, which is as good as the PMJJ, everything, where you will actually end up spending, but you will create a relationship which I think will be really be good in terms of times like this.